Welcome back to the Thinking Crypto podcast. With me today is Greg Dickerson, who's no stranger to the show. Greg, great to have you on.
Hey, Tony, it's good to be back. Good to see you.
Greg, well, I wanted to start the year off with getting a holistic perspective of the markets, and you're the person that I thought of to speak to talk about real estate, stocks, and crypto. But we have the Fed still at it, still looking to raise rates to fight inflation. What is your outlook for this year with what the Fed may do?
Yeah, so I'm very optimistic. I think we may find a bottom in the markets. We might start to see, we'll talk about real estate later, but we're going to, see where that's headed. So we're going to get a lot of information here in Q1 the next few months. So as far as the Fed goes, the information they're going to be looking for and looking at, number one is going to be the inflation report. For December, we're going to see what that looks like. And if we continue to see the trend of inflation declining, that's good, positive news for the Fed. The job market is still a little bit strong for them. Inflation is still high in two main areas, food and housing and shelter. And as we both know in real estate, rents are really high for a lot of people in a lot of areas, starting to correct a little bit in some areas, but that's off of very high distorted levels. So there's still some work to do there. So that's what the Fed's really looking at. So the Fed is going to continue to potentially reduce the pace of the rate hikes, but they're going to leave them there as long as it takes until inflation is down to 2%. They have not come off that 2% target yet. They might potentially have to this year, depending on what inflation really looks like, how things are going. And, we're really going to learn a lot about the consumer once we get through the holidays, because what we're coming off of is, pandemic cabin fever. Mm-hmm. So people were getting out, traveling, spending. Then you add the holidays to the mix, and that stimulated a lot of spending and, stimulated growth in the economy. So what we're going to see now with earnings and things like that, and the consumer, we're going to see, is the consumer really in distress? Are they really pulling back? We're starting to see some cracks in the real estate market with mortgages and delinquencies and lates. We're starting to see some cracks in, consumer debt. And the banks are going to be the first to report, in next couple of weeks, I guess, when reporting starts, earnings start coming out. So we're going to learn a lot about the consumer, their bank accounts, their credit, things like that. So a lot of really good information coming out here in the next month or so that will guide the Fed when they meet in February.
Sure. And what we saw, they started raising rates at a lower increment, meaning like from 75 to 50 basis points. Are you anticipating that, look, we'll probably have 2 to 3 more rate hikes, but maybe they're going to be at 0.25?
That is a potential. If the inflation report is good, positive for the Fed, then they might start backing it down to 25 basis points. I mean, they still have their target at, I think it's 5.5, somewhere around there. They have to get the Fed funds rate above inflation. So they got to keep hiking until they see inflation really retreat and they start getting closer to that neutral position, which is the Fed funds rate at or higher than inflation. So it's really going to depend on that. But yeah, that's what they've indicated. That's what they've shown by the 50 basis point rate hike. And that'll be the big debate. Are they going 50 or 25? And, I think the 75s are done for now, definitely.
So do you anticipate that, look, for at least the first half up till June or so, there's still some pain, but then the Fed, if everything goes according to plan and inflation is maybe at a number where they're, okay, we're going to back off, we're going to pause, that the markets will start to rally a bit just because you're at the oversold position?
Yeah, and we'll take a look at the charts in a minute. But yeah, I mean, if the Fed comes out positive and says we're going 25, the markets will rip. And the markets are setting up for another rip. There's a little bit more downside yet. And I think we need to test and probably break those October, November lows, depending on what you're looking at, which index. Bitcoin and crypto are a little bit different. But, in traditional markets, there's definitely a setup to go back, retest those October, November lows, see if they hold. They probably won't. We'll probably set a new lower low, and then we can start potentially putting a base in if the Fed is backing off of those rate hikes. And, then we get into what does the economy really look like? What does earnings look like? Inflation could still be a problem. I mean, we have minimum wage increases, coming across the country with the new year. A lot of states are hiking, the minimum wage, which I think is irrelevant anyways. I think, with the labor situation, most businesses have had to pay, $15, $20 an hour for those minimum wage workers anyway. So I don't know that that's going to make a big dent in things. But the strength of the consumer, I think, is going to be tested here in January with taxes, credit card bills, coming off the holiday spending. Everybody needs to pull back. And that's what the Fed wants. They need to slow the economy to get inflation down. And then there's a couple of people saying that we might get a double peak in inflation going into the second half of next year. So we'll see how that goes.
Funny you say that because Michael Burry, the big short himself, right? He tweeted out last night about that. Interesting statements from him.
Yeah, and it's possible. I mean, he's not really backing it up with any kind of a why other than he says the Fed's going to pivot, the economy is going to get strong and resilient, and that's going to create another spike in inflation. But you have China reopening, which is going to help free up supply. There is a deglobalization going on, which is putting pressure on prices. The labor market is still a problem and hasn't corrected yet. That's the big thing the Fed has to get a hold of and really correct to really. That's why I'm saying inflation target might have to go up, because I don't think the Fed's going to be able to affect the labor market. There just aren't enough people to fill the jobs. Unless we open the borders and start bringing people in, we're just not going to get labor down in the services industry and in the skilled labor industry. It just continues to spike. That's going to keep pressure on prices. That's why I say I think inflation is going to stay higher than the Fed thinks, and they're eventually going to have to give up on 2% and raise that to 3 or 4, which is significant. But if wages are going up, then it's kind of a balance. Then we have a new normal.
Greg, this is not a political podcast or anything, but it's so funny how a lot of issues and problems come from how they handle the money and what the Fed is doing. But the politics comes in and each side throws stones at each other. But I mean, you just said they're like they illegal. I don't want to say illegal immigration, but whatever. They would allow that to even help to fight inflation and get wages down. That's kind of mind blowing.
Plenty of other countries that have figured it out. It's just a political, nonsense that we haven't figured that out. And that's what built this country. Nobody's from here.
Right.
I mean, Native Americans, obviously, but other than that, nobody's from here.
Exactly.
So this country was built on immigration. That's what makes this country great. We welcome. And there is a process for that, but it's way too, difficult. It's inefficient. We just need to bring people in, give them an opportunity. I mean, there are states and communities begging for workers, and there's, qualified people willing to work and take these jobs. And the old argument used to be that they're coming in and taking jobs from Americans. And that's just not the case anymore. People don't want to do those jobs, or there just aren't enough people available for them. So, we definitely need to do that, and regardless of, political affiliations. But yeah, I mean, so the Department of Insurance writes our laws, right? So there's political in terms of our laws and the laws of the land. That's who writes, a lot of like building codes, seatbelt, all that kind of stuff comes from the Department of Insurance. There are insurance companies lobbying for those types of laws. And you have the Department of Labor writes a tax code, so pretty much everything we do is politicized. Then you have the Fed and the Treasury. They say they're not, held to political will or bend to political will, but Biden calls up Powell and says, look, buddy, you better get inflation under control. So what's the perfect political setup over the next 2 years? To continue to crash the economy, put the country into a huge recession, and then all of a sudden pass, pivot, stimulate, do everything you need to do to bring everything back for the election year in 2024 in 2 years. So it looks like, the incumbent party has created this great economy, through stimulus. And that's where that double top inflation comes from narrative that, Michael Burry's talking about. He didn't read the politics into it, but sort of is, if you look for a political setup in the economy, that would be a good one.
It's just so funny how they handle the money. It impacts our lives. And yes, the politics get thrown in it, but it's just, I think that still hasn't sunk in for me, when I hear, okay, they want to crash the economy. And it's like, I wonder if the average American knows that, or they just look at it as, well, this party is bad or Biden's bad or something. But it's like, they have to kind of do this, which really sucks.
Yeah, most people don't pay attention to the what and the why. They just know, I can't buy groceries and I can't afford rent. That's what most people know. They don't really understand the why behind it. And it all goes back to interest rates. I mean, at the end of the day, what drove real estate values and what ultimately is driving rents is because, interest rates. They dropped the interest rate so low, and they were buying mortgage-backed securities all through the pandemic, even when it wasn't a problem anymore. I mean, it's just so mind-boggling. But if you go behind the scenes, and if you could find the messaging and the behind the scenes and closed door conversations, I guarantee you, it's Wall Street investment funds, investment managers lining the pockets of the politicians that are saying, "Look, juice the markets, keep it going." And I mean, when we look at the charts, I'll show you. It'll just blow your mind. It's all money supply, liquidity, zero interest rates. I mean, that's what drove it before 2008 and 9, and ultimately crashed it. Now, there was a different component in the real estate market because of the subprime lending and that push. But at the end of the day, it was cheap interest rates that drove the values of real estate. That's what drove the value of commercial multifamily properties. People have to pay more. The only way they can afford that, and the only way the deal works, is they have to raise rents. So, I mean, you're seeing it. It's becoming more prevalent over and over, even in New York, where rents dropped to record levels during the pandemic. That's coming back now. People are seeing, double, 40, 50, 100% rent increases, on lease renewals. It's ridiculous.
It's crazy. I look, I'm not far from New York. My parents live in New York, and I'm just surprised. Yeah, the same thing. The rents went back up, but it's like a lot of businesses are not back yet. There's a lot of people who left and haven't come back. So it's really strange what they're trying to do there. Anyway.
And that's a big one too, because again, the Fed wants the economy to slow. Now, they don't have any control over rents. The only thing that affects that is interest rates. So that market is correcting, which is ultimately going to correct potentially, rents. But now it's getting more expensive. So you have to raise rents even more because interest rates are raising. So it's kind of a double-edged, dichotomy going on there, where let's raise rates so we can slow the economy, but that puts pressure on real estate, where you have to raise rents more because it's more expensive to refinance that debt. Right. So, they've kind of made that even worse.
Let's look at the Bitcoin and maybe Ethereum charts, and if you can tell us what you're seeing in the short term and also what you're anticipating in the long term for this year.
Okay. And, here's the traditional markets. One of the things I was talking about, is when you look at, this is the monthly chart of the Dow. And when you think about liquidity cycles and money supply, and I'm no technical analyst, I use the free TradingView version just so I can spot trends. But I mean, you just look at this. I mean, this goes all the way back, to the history of the Dow. This is the first peak before 2000, right in here. And then, you drop, and then you have your next peak before 2009. Then it drops. And this is a parabolic QE money supply that we've seen with a blow off top. That's the Dow. Here's the NASDAQ, same chart. Here's your 2000 top right here. There's your 09 bottom. And this is where QE started. This is where, toxic asset repurchase program started. This is where, all of that started. And then, just straight up with a blow off top. This is your pandemic low here. And then the S&P, same thing. I mean, it's just, this is what they've done. And that's what's going on. This has to unwind. So when you take a look at Bitcoin in the same perspective, this is Bitcoin on a monthly, same kind of thing. This is your 2020 or 2017 high, then it drops down, your pandemic low, and then straight to the moon. Then you had that, irregular correction here before that previous, that November top, and then downhill ever since. Let's go ahead and drop it back to the daily here. And, it's just doing the same thing. It's just leveling down, right? So the big problem with Bitcoin and crypto that a lot of people don't understand is that it takes a tremendous amount of new liquidity to drive the price. So what you've lost is like right in here. So this was Do Kwon. This was Michael Saylor. This was Celsius. This was, everybody just printing fake money and buying. Michael Saylor borrowing at, a blended rate, like he says, of 2% or whatever it is to buy Bitcoin. Mm-hmm. They can't do that anymore. He can't borrow anymore. It doesn't work. Miners, they have to sell. They can't borrow anymore, to make it work. Do Kwon's gone. Celsius, Three Arrows Capital, all the hedge funds that were, borrowing money and leveraging to drive the market, they're gone. The only thing keeping this alive right now basically is Binance and Tether. I mean, and if you don't believe that, I mean, just look at what FTX was doing. FTX owned the market makers that were driving the price, and they were trading against their clients, propping up the price of these assets. So, that's kind of what's going on right now. This is not a retail driven, trading range here.
Sure.
This is, there's still a lot of stuff being printed out of thin air, keeping the price propped up. And that's not a bearish FUD, whatever. That's just the truth. And until that dust settles and it clears out, we're not going to find a true bottom in this asset. We're going to find a lot out about that when FTX, when Sam Bankman-Fried goes to trial. You're going to see a lot of stuff get exposed. The next leg down is just a matter of time right now. There's still a lot of funds out there that are trading and using this leverage to kind of keep the market propped up. The other thing you don't have is the stimulus, right? Retail traders that were given stimulus checks or were putting in the market. Some of that was going on back in these areas here, kind of keeping things alive and the hype. So
sure,
almost all the retail traders are out of the market. They're gone. The Tom Brady's, people like that. They don't want anything to do with crypto. So this has to recycle. Now, I'm not a bear. I'm not, I understand Bitcoin intimately. I know what it was created for. It makes a lot of sense as a peer-to-peer exchange of value, using it, in that manner. It's not money. It will never be money. It's a commodity. It's digital property. That's what it's going to be. That's how it's taxed. That's how it's going to be regulated. So it's not going anywhere. But you got to clear all the junk out that's artificially propping the price up. And you have to get a whole nother wave of investors to have confidence in the asset in order to drive the price. So that's kind of why you have these cycles. A lot of people say, oh, it's the halving cycle. That's just a narrative, that people put out there and people buy into, saying, oh, there's only going to be half as much, I better buy. That's not going to work anymore. People are kind of wise to what's going on now, and they've seen this, and there's a lot of awareness here. It's going to take a lot longer, now to get more capital into the space to really drive these prices. And ultimately, we've got to get to that next level down. And, like I've said before, we've seen these levels twice now of 3,500 to 4,000 in severe conditions. And then you've got this major, macro support level in that 10 to 12,000 range. And I think, it's heading there. It's going to get there. And the question is, will 10 to 12,000 hold? And I think it will. I think unless there's a severe situation in traditional markets, that 10 to 12,000 is going to hold. I don't see a 4,000 Bitcoin unless something really bad happens. Ethereum, same thing. This was all speculation on the ETH merge. Everybody kind of pumping it and dumping it, and it's kind of hanging on. But I think for Ethereum and all the other altcoins, I did a video the other day. I think they're all going to round trip. And what I mean by round trip is go back to where they started before this liquidity-driven cycle that I showed you started. And, that puts ETH at about $100 to $300.
Wow.
XRP is just hung up in its own thing. Cardano, you're almost there, back to single digits, right? And it's 25 cents now. It's been, a penny or two is where that started. Solana, same thing. Solana was, started at zero, but it consolidated for a while there at that $1 to $2 range. That's where it's headed. It's popping up here and there with a little bit of the market makers kind of driving these speculative moves here, which you can get some nice little trades, with the asset being so cheap, it doesn't take as much money to drive it. But that's just where you're at with altcoins. They're round tripping. They're all going to go back to where they started basically before this run. Sure. Because for most of these, and this is not FUD, this is not whatever, it's just the truth. Most of these have no fundamental use. They're all speculative. They're all just projects that have individuals that created this company, issued tokens out of thin air, and then other exchanges and other investment funds use the hype to drive the price and manipulate the price. That's what's going on. There's no real fundamental at scale use case behind a lot of these projects. They're just, a lot of them are flat out scams, and those are getting washed out. And some of them have some potential, like Ethereum, obviously, and Cardano and Matic and, Solana, things like that. But when you look at the real technology behind them, a lot of these games and, things like that, they're not that great, and they're going to get replaced. That's how technology evolves. New technology comes, replaces the other stuff that becomes, outdated. So, that's kind of what's happening. And that's what a lot of these tokens are doing. Litecoin, same kind of thing. Litecoin, back in the, $20-$30 range, probably less than that. This must be coin. No, this is Binance, so I don't have a whole lot of history on Litecoin. But that's just kind of the truth of where it is. ApeCoin's kind of hanging on because it's got a good little, community and tribe, and like an AMC or a Tesla, kind of thing. And, same thing's happening with like Tesla. If you go look at a stock like Tesla, Tesla's round tripping, right? I mean,
Yep.
it was basically in that $20 range before all the liquidity. So they're facing competition, their market share is diminishing, their technology and cars aren't that great. Now you have Elon alienating, talk about politics, alienating most of the people that buy and drive Teslas are, more on the liberal side, and he's going to the far extreme of the other side and alienating a lot of those people. So, it's interesting times.
Yeah, it's very interesting times. So, to your point, with Bitcoin, let's say we drop down to the 10 to 12K range. You think we hang out there for, till the middle of the year or so, and then then once again, if the Fed does pause to a certain degree, that Bitcoin will rip too, along with the traditional markets, and maybe, do you have a price target there? Is it like 30K or so, and then it corrects? What are your thoughts on that?
Yeah. So, Bitcoin's been sitting out big rallies that the markets have been experiencing, again, because a lot of the capital that was flowing in there is gone and people are afraid of it now. So, general investors that would normally have participated, they don't know where to go. What exchange do you use that you're not going to lose your money, or they're not going to go out of business and lock up your assets? Can you get them off the exchange in time before that happens? So there's so much fear out there, and there, uncertainty and doubt, rightfully so. It's just hard to say exactly what it's going to do. But I could see, if we go back and look at, I mean, this is kind of what I could see, especially if the Fed, comes with another narrative that, they're going to potentially slow down or stop at some point, is I could see price right in this area before we ultimately go to new lows, jump back down, test this previous low that we put in at 15.5, shoot back up again to this 20, $20,000 range, see how far it gets. I don't see it getting much further than there, and then ultimately down to that $10,000-$12,000 level. I mean, that's kind of what I really feel like the technicals are kind of saying and showing that Bitcoin's going to potentially do. We get some bad news with inflation, and things like that, or something else happens, like there is some stress in the credit markets where companies can't refinance their debt, so that could cause some problems and bankruptcies and things like that. It could potentially just lose this level and go down straight down to that next 10 to 12,000 level, and then it'll consolidate just like it's doing here at that level to kind of see what's going to happen. How does the market look? What does recession really look like? What's the Fed really going to do and when? And, that's how the markets are built. So crypto goes through these phases of peaks. I mean, this is nothing new. We haven't dropped to where we normally do drop, 85% to 90% on some of the assets and some of the markets. Bitcoin, I think it's only down, 73% or something right now.
Yeah.
Yeah. So, I mean, it could still go down to 85 from the all-time high and still be well within what it normally does, to wash out a lot of the dust and, get that consolidation, period going, bring in more capital, and then ultimately lift it off. The problem is you don't have the players to drive the price the way they did in the last run. So the question is, how high can it really go this time? And you do have more institutional investors that'll potentially get involved if we have some regulation, and we have some exchanges that we know we can trust and things like that. That could ultimately drive, Bitcoin a little bit higher and, more towards that $100,000 range at some point. But there's still so much uncertainty right now. What is the economy going to look like? What's the Fed really going to do? How long are they going to do it? And are we going to have a recession? How deep, how long, how short, how shallow? So there's still a lot of questions out there, but I could see, getting back to the 18 to 20 in the interim, then rolling over, putting in that 10 to 12,000 range, and then sitting there for a long time. And the narrative is, if everybody's expecting it, it's not going to happen, right? Everybody says that. Not everybody expects it. There's a lot of people that still think it's going to just shoot to the moon from here. A lot of people that think it's going to go a lot lower from here. What usually happens is it goes lower than you think, longer than you think, higher than you think, longer than you think. And that's just assets like this that are tradable risk assets in general. So just because everybody thinks it's going to go to 10 or 12, or a lot of people think, and if you run a poll, it's 50-50. Not everybody thinks that.
Sure. So let's talk about real estate. We talked a bit about rent prices, but you as a builder, a developer, what's your outlook? Are you touching anything right now? Or are you still waiting to see, or are you, flipping anything, buying anything? What are you planning to do?
Yeah. So builders in general are pulling back. So the only thing I'm bullish on right now is building multifamily because there is a demand, for rental units and things like that. And I've got a lot of clients I'm working with around the country that are doing those types of projects. But as far as building product for sale, this is not a good time because interest rates are still they've spiked again. They came back a little bit with the treasuries, 10 years up again. So interest rates have gone up. So there's still pressure on the housing market. And I think we're going to see where that's headed because what typically happens is inventory reduces in the holidays. People pull their houses off the market. So we have a very stressed inventory level in housing right now. There's just nothing out there in most markets. There's no inventory. People pull that off the market in the holiday season. Then they start putting it back on the market after that, January, February, March. And again, we have all the bills coming due, taxes, credit card, all the spending coming off the pandemic going into the holidays. So I think there's going to be a lot of people that potentially want to are going to have to sell in order to pay off some debts. A lot of people bought new cars because of the pandemic incentives and things like that. And the average car payment's almost $1,000 now. So there's a lot of people that are going to have to sell some assets to kind of work some of that stuff out. We're already seeing defaults in the auto industry with people that are buying a new vehicle cheaper than they bought and just walking away from the old one and keeping the new one. Even with interest rates a little higher, they can still get a vehicle cheaper because that market's correcting. But real estate, the real question is, are we going to see a flood of inventory coming into the spring like we typically do? And when you couple that with higher interest rates and less demand from the buyers, you could potentially start to see a real correction in the housing market. But most people don't have to sell. They have really good mortgage rates. There's nothing for them to buy. So it's such an interesting time. It's hard to predict what can happen, what will happen. We are seeing price corrections in a lot of markets, 20, 30%. A lot of YouTubers making videos about that. But again, that's coming off very distorted levels. What you need to look at is where were housing prices before the pandemic, before that zero interest rate, drove those prices up 30, 40%. So if we're correcting 30 or 40%, we're just kind of back to neutral, kind of back to where we could be. So you really need to see a correction off of that before you're really talking about a dip in the housing market. 30 to 40% right now doesn't mean anything. That's just kind of what it ran up over the last couple of years. But it's going to wipe out the equity a lot of people have in their houses. So that's a wealth effect. And again, the Fed wants that. They want people to feel less wealthy so they can get a hold of inflation. So, interest rates are key in the housing market. It's the cost of the capital and the availability of the capital. That's the two things that drives a transaction in the real estate market. Then you have location and demand. I mean, very unique properties, regardless of the environment and the climate, are always going to, command a higher price. Trophy assets, things like that. And, real estate's hyper local. But when you look at the average across the industry, that's kind of what I'm talking about.
Yeah. I just keep thinking about the Fed and trying to destroy wealth, crash the economy. And it's just logically, it doesn't make sense. But on paper, and how the finances and how the system works, the debt-based system works, that's what they got to do.
Yeah. And it's been this way. We go through these peaks and valleys, and we've seen it in real estate over the history of real estate, but it always goes up. At the end of the day, even after these corrections, it still kind of always goes up. I mean, we haven't gotten back to, levels 10 years ago yet. Sure. So that's the one thing. Markets 80% of the time or whatever it is are always going up, but you have these corrections when you have distorted levels, when you have intervention, from the Fed, like we've had. You're going to get corrections when you have, the tech speculation bubbles, speculative bubbles. You're going to get those corrections. So, I'm looking forward to this time because I think we can start to get some clearance. We can start to get some understanding. Assets can continue to reprice, start to find that base and put in that bottom in all of the markets, all of the assets. So now we can be off, for another run. The thing is, unless you have conditions like we had before with money flooding the market, interest rates dropping, and the Fed really pivoting, I don't think you're going to see an exponential explosion like we saw before. It's going to be more gradual like it has been. If you go back before 2009 and kind of look at that, run up, we've seen some exponential V bottoms because of, Fed and monetary intervention.
Greg, do you feel like, yeah, I think I remember someone using this analogy that we've now become crack addicts where they have to keep pumping the markets like that. The old economy has died, and this new system of pumping markets seems to be the status quo, and it feels like they can't go back. The cat, genie's out the bottle.
Yeah, well, with inflation, they can't go back. That's the biggest problem. And, if you rely on the Fed on the way up, if you believe the Fed on the way up, buy the dip, the Fed's going to rescue the markets, the bottom, when they're going to pivot. If you believe that on the way up, then you have to believe the Fed on the way down, higher for longer.
Sure.
And that's where we're at right now. So until the market gets that through their head and we reprice, because valuations are still well above where they need to be on pretty much all the markets, real estate, stocks, vehicles, everything. Until that correction reprices, we can't put a bottom in. And then once that does and everything resets, well, then we can start looking for that, that bullish case again. And that could come around, maybe second half, potentially. We could put a base in the first half and then start that journey back up again in the second half. But there's going to be a lot of pain and a lot of people that are going to be surprised at what's going to happen and what could happen between now and then.
Sure. Greg, always insightful information. Thank you so much.
Yeah, it was great chatting with you. And, the big takeaway here is I'm opportunistic. I'm very optimistic and opportunistic. I look for the opportunities. I'm optimistic that we're going to see a recovery. I've been through it before. I've seen the tech revolution going from, all the way back before the 2000s and where we're at now. Crypto is no different than the tech sector in terms of emerging technologies and the cycle that they go through. Sure. I'm very bullish on the crypto sector. I'm very bullish on Bitcoin. We just have to clear all the junk out. We need to get some regulation, some security that our funds are going to be safe. We need that security in order for the space to evolve and for these assets to increase again. But they will. That's going to happen. We'll be off to the races again. And, you might be able to get a nice little 10x out of Bitcoin and a 20x, out of some of these cryptos. It's going to be a lot of fun.
Yeah. It's just a lot of patience until we get there, right?
That's it. That's what the market does.
For sure.